Have you ever found yourself feeling confused about open and closed mortgages? Because there's so much slang in the industry. Like any other industry, the financial industry has a lot of slang. So most people would think that a closed mortgage is a fixed mortgage and a variable rate mortgage is an open mortgage. Well, hopefully with this video, we're able to help you discern between the two mortgages. My name is Jacques Dupree. I'm from Mortgage Allies. We love to decommoditize mortgages and help you to become mortgage-free faster. Hopefully this video will make a difference to you and will make you more savvy the next time you pick a mortgage. So let me start by defining the three types of mortgage that we get in the industry. You get a fully closed mortgage, you get a fully open mortgage, and then there's another type which probably you've not heard about before, but that really is the standard mortgage we get in the industry, and it's called a partially open mortgage. So let me start with a closed mortgage. A closed mortgage essentially means that you cannot get out of that mortgage even if you want to. So in other words, even if you want to pay a penalty to get out of it, you are not able to get out of that mortgage. You can only get out of a fully closed mortgage at the time you sell the property or at the end of the term. So the question is, why should anybody take a fully closed mortgage? There is no reason why anybody should do that. Banks essentially present fully closed mortgages to us because they force you to be loyal to them. They know that for the next 5 years, they essentially quote unquote own you. So I would tell my clients always to stay away from a fully closed mortgage unless that is the only product you actually qualify for. There are some lenders that present you with a fully closed mortgage, and because it's the only option you could potentially qualify for. The second mortgage type is a fully open mortgage. Now, fully open mortgages are always higher in interest rate, and the reason why they're higher in interest rate is because the investor says you can leave at any time and they want to get a return on their investment. So a fully open mortgage you should really only take if you're in transition, such as you're selling your home and your mortgage is maturing, but you don't want to be locked into another term. That is essentially what you do with a fully open mortgage. As I mentioned before, they are higher in interest rates, but they have a lot of privileges to them. You pay no penalty to break them, so they're great products. Then the final one is really a partially open mortgage. Partially open meaning it's not fully open because you're still paying a penalty, but it comes with a lot of privileges, such it's portable, it's assumable, you can pay a lot extra, you pay a penalty to break the mortgage. So partially open mortgages are really what most of us have, and you should also be careful, just because it's a partially open mortgage, not all partially open mortgages are created the same way. I hope this has been helpful to you, and as I mentioned before, we at Mortgage Allies help to educate and help people to get out of mortgages faster and to decommoditize mortgages. Why decommoditize mortgages? Because they're not coffee and they're not gas. It's not just about the interest rate, it is about getting mortgage free faster. Until the next video, stay debt free.